debate hosted by Stanford and Government, along with several other organizations, including Stanford Democrats, Stanford Republicans, Stanford Speakers Bureau, Stanford Women in Politics, Stanford Politics, and the Stanford Review. Thank you all for coming tonight and for wanting to engage in discourse around a really meaningful policy issue. The debate is going to last for around 45 minutes and then be followed by roughly a 30-minute, so maybe a little more community discussion / Q&A, where all of you will have the opportunity to ask questions of our panelists and engage in discussion and thought around the issue. For the debate tonight, there are 4 ground rules that I'm hoping everybody in this room, or we will hold everyone in this room to, so that we can have a civil and sustainable debate, so that we can have more of these. Because if this doesn't stay civil and isn't productive, we can't really do more public debates under Stanford government. So the first of which is that there are no ad hominem attacks allowed here. We're here to litigate ideas, not people. The second of which is you're entitled to your own opinions, but not your own facts. We will be having 2 live fact checkers here. Each side has brought all the facts and the things they're going to use tonight. And if one side believes they are not using those facts or using them correctly, they can call for a fact check. The third of which is keep an open mind. Ask yourself, what do you need to hear to be convinced that your ideas around this issue are wrong? And what facts do you need to hear to be convinced of those things? And the fourth is to speak with good intent, meaning only say what you truly believe and assume the other side is speaking with good intent and that they're really speaking from the heart. So without further ado, I'm going to turn it over to our moderators, and I hope you all enjoy.
Alrighty, so like Michael said, we're discussing the Tax and Jobs Act of 2017 tonight. Our main question will be, is the Tax and Jobs Act of 2017 good for the American people? And I think we're going to do a coin flip to decide who goes first. Call it.
Heads. So we have tails. Yes.
And it's tails.
Okay, great. All right, we'll go first. 2 minutes for the opening, right?
Sorry, yes. 2 minutes to the opening. Sorry, 1 second.
Alrighty, go ahead.
Great. All right, well, good evening, everybody. My name is Gabe Rosen. I'm the current president of the Stanford Democrats. Debating with me is the vice president, Matthew Wigler, and board member, Caleb Smith. Now, we're here tonight, as the moderators just mentioned, to discuss the Tax Cuts and Jobs Act recently passed by the GOP. When it comes to the primary question of whether or not that act is good for the American people, we want to begin by stating that we believe that this policy will not, in the aggregate, be good for the American people for a multitude of reasons that we'll get into over the course of the debate. But just to give the broad strokes of what we're going to be bringing up, we want to make sure that this is all steeped within economic fact. We want to make sure that this is not about maligning the views of the other side, making sure that we're also not maligning the intentions of our elected representatives who passed this bill into law. What we want to do and set out is to try and provide the perspective coming from our side as the Democratic Party. We want to make sure we make it clear that this bill is only, in essence, going to provide benefits to the top 1%. As you'll hear, of course, there are tax cuts in there for people in the lower and middle class. But on the whole, the complete package is not going to provide substantive benefits in the long run for the working and middle classes. And in essence, in the long run, due to these unfunded liabilities that we are creating for ourselves, the repeal of the individual mandate for the Affordable Care Act, we are only going to pass the burden onto the very classes that this bill is purporting to help. So we are standing for those who feel that they didn't have a voice in this process, and we want to make sure that we give as much attention as we can to the fact that this bill is only going to be helping a small proportion of this country, but we want to stand up and advocate on behalf of everybody. So thank you, and I look forward to the debate.
Perfect timing. All right.
On December 22nd, 2017, President Trump signed the Tax Cuts and Jobs Act of 2017, and that included 2 major changes to the U.S. tax code. For one thing, it reduces individual income taxes for the vast majority, about 85% of Americans, notably almost doubling the standard deduction, lowering the top marginal tax rate from 39.6% to 37%, and doubling the child tax credit. Second major change is that it reduces business taxes, notably cutting the corporate rate almost in half, and allowing for full and immediate expensing of short-lived capital investments. Now, we would like to argue that specifically, these changes, although they may seem to perhaps have some benefits for the wealthy, also do significantly impact the lives of lower and middle income Americans as well. Even though perhaps there are, in fact, tax cuts at the top, tax cuts of the marginal tax rates at the top, 5 of the 7 brackets have tax cuts. 5 of the 7 brackets are going down between 1% and 3% for the benefit of people at all income levels. Also, the growth of the standard deduction not only improves the tax liability and reduces it for people, especially at the bottom, but it also reduces the pressure to itemize by offering a greater benefit to just taking the standard deduction, which is probably the easiest way to file taxes. We also would like to argue during the rest of this debate that the corporate tax cuts also do help the lower and middle income classes as well as the upper classes, because they help to increase wages and increase investment in increasing hiring for all of American workers as well. And for that reason, we would like to argue during this debate for those 3 things: that the tax cuts apply to everyone on the individual level, that the corporate tax cuts impact everybody in a positive manner, and especially that the standard deduction and a few other deductions such as the child tax credit end up reducing the pressure to engage in complex itemization, for which only wealthy people often have the accounting expertise and or money to hire an accountant to deal with.
Awesome work, guys. Okay, so just before we proceed into the free section, can everyone in the back hear? Good, okay. Just remember to speak loudly because we don't have a sound system here. So just a reminder going into this, we're using a chess timer, so there'll be 20 minutes of debate for each side that can be free-flowing back and forth before we go into the Q&A. When one section switches it over the floor to the other section, we'll switch the timer so that way each time gets an equal amount of sides. That can be used for questions for the other sides, debates, points that they'd like to counter, etc. So, thank you. Okay, Dom's here first.
Thank you. Thank you, yes, and thank you to the Republicans for describing some of the prominent features of this tax legislation. We would like to dive into a few of these and address them point by point. First off, with regards to the lower tax brackets, it's worth noting that for the deductions in these individual tax brackets, an overwhelming proportion of the benefits are going to be flowing to the top 5% of Americans. Well, the proportion of benefits that flow to the bottom 40% of Americans is going to be relatively small from the changes in the tax brackets. It is good that the child tax credit has been increased. However, this is a massive missed opportunity to increase the earned income tax credit, which is another bipartisan supported opportunity to support working middle class Americans. As for the higher standard deduction, we also would agree that is a good idea. However, by reducing the top rate for many Americans who are earning the most money, it's a missed opportunity to increase the standard deduction by even more. As for, and it's also important to note that these individual tax bracket reductions are temporary. They only last for about 10 years. On the other hand, the corporate tax cuts are permanent. And when these individual tax cuts expire, Americans who are earning the least amount of money can expect to pay more than they are paying previous to the enactment of this tax, ladies and gentlemen. It's important to note that for these corporate tax cuts, previous studies have suggested that although some proportion may go to workers, the benefits flow primarily to the shareholders of those companies through such things as stock buybacks. This further exacerbates income inequality and makes it so that the economic benefits of this act, such as they are, and we will argue that they will be limited, will flow disproportionately to those who are already the best off. Once again, as my colleague pointed out, making it so that a handful of Americans benefit overwhelmingly from an act that purports to serve all of us.
Great. Thank you all for being here and engaging in this discussion. I want to start first by giving a couple examples about what the tax plan has already done and then diving into some of the details of what they brought up. So as we know, there's been a lot of companies that have actually given out bonuses. And one of the big arguments that the Democrats have been making is that these tax cuts seem to be concentrated among the most wealthy. But what we've seen already is companies coming out and increasing bonuses, their average wage for the average and rank and file worker. It's not as if the shareholders are getting the gain already. So what we want to just emphasize is that the proof is really in the pudding, and we're already seeing that. Another point that we really want to stress, coming back to an argument that Philip made earlier, is that when corporate tax rates get reduced, that allows companies to optimally allocate their money in much more efficient sort of ways. So for example, in a 2010 working paper by Kevin Hassett and Mathur, they used data from 65 countries between 1981 and about 2006, and they show that whenever the corporate tax rate gets reduced by about 1 percentage point, about $3 to $4 goes up in terms of real wage growth for the average worker. And so when we're trying to think about the data that exists across countries or within countries, the corporate tax rate reduction has had a lot of very positive effects on workers. One of the points that they brought up is that it's primarily going to affect shareholders. And what I think we need to keep in mind is that shareholders are people too. And who makes decisions about whether to expand a workforce in a company? Well, executives in a company are going to make these decisions. And so the way that you get a plant opening up in a particular state or particular county is by executives that are making a decision as they say, well, we have more money on our books now, and as a result, we're able to expand our operations in a particular place. There's going to be a lot of other things that we look forward to getting into tonight. But what I just want to wrap up on are a few final points that they made about rising inequality. We agree inequality is a very important issue, and our hope tonight is to try to discuss how this corporate tax rate reduction and the decline in the marginal tax rate for the average worker will allow people to have more money in their savings account so that they can use the money the way that they see fit rather than having the government kind of take it away and then the government make the decision to do that. And lastly, the EITC is a great thing. There's a ton of bipartisan kind of consensus about the EITC being good. If we had our way, we'd have put the EITC kind of expanded that even more so. But I think that the debate tonight is about, is this plan net beneficial for workers? We can agree on probably about a lot of things that maybe could have, would have, should have been in the plan, but I think that we're going to try to come away and say that this was net beneficial. So I guess hand it over to you all.
Okay, so just to build off that and then put it to you. Just want to emphasize that when it comes to the structure of the tax plan, I think it's also very useful to talk about the overall macroeconomic situation that we're working within, just to provide some context for the passage of this plan. So something that we had a bit of a question about that we hope that our colleagues on the Republican side will be able to answer is, why is it that during a time when arguably the economy is essentially close to full employment levels, when our stock market is doing incredibly well, it seems that we have recouped a lot of the losses that occurred during the Great Recession, that we are now enacting essentially what should be a stimulus initiative that should be done during an economic downturn. And in doing so, we're setting ourselves up with trillions of dollars potentially in an increased debt down the line. The deficit funding of this will eventually be placed on these lower and middle income individuals who for now might be getting temporary wage increases. But those wage increases, I would also ask my Republican colleagues to be upfront about the actual dollar amounts here. We're not talking about very large amounts. These are very small in proportion to tax benefits and breaks that the 1% and these managers are going to actually be getting. And furthermore, when it comes to the actual amount of taxes that these companies, corporations pay, there are all these estimates out there by World Bank and other groups that show that there are plenty of offshore assets that are being held in tax shelters overseas that aren't going to be recouped or brought back and spent in local businesses and invested in local areas. So I would ask a question to Republicans. Is there a reason why you feel it was justified to structure a tax plan in this manner instead of trying to encourage a tax return, in essence, to America and to leave this money offshore and instead of directly investing in infrastructure, while it seems that there's an incentive for these corporations to just have their CEOs buy back stock and line their own pockets?
In the tax reform, there was also actually a specific rate established, a one-time rate for money return, and it was a little bit lower, obviously, than the generic rate, in order to encourage money to come back home to the United States. And in fact, Apple is about to increase by a very significant amount investment in the United States, a good example of a large company doing so, and it specifically credited the tax plan for being part of its encouragement to do so. So I mean, I do think that there's concern, yes, that there's money being kept overseas, and that's something that I think both parties and all Americans, people even of no party, should be concerned about, because obviously we want to have that money being contributed to our economy and our tax base. But I think that it's worth considering maybe the positive impact that this bill also had on that, while recognizing that there might have been some shortcomings and could have been yet better on that front.
So, thank you again to the Stanford College Republicans for joining us to engage in this discussion. I'm really glad with the direction that we're moving in, listing real-world examples from how corporations are responding to this. And you brought up some good ones before with Apple. There's another good one where Walmart has decided to raise their wages as a result of this. There are some other ones that I think are worth hearing as well. I think it's worth paying attention to the fact that Cisco, Pfizer, and Coca-Cola have all announced that they're going to be using the cuts that they're receiving in order to pay out corporate dividends. I think it's worth noting that the CEO of Amgen is going to be doing stock buyback, which will raise stock prices if you're in Amgen, but if you work for Amgen, is not going to raise your wages. I think it's important to note, based on what you said before, that if what we really want is for corporations to have more money with the expectation that they're then going to pay that out in wages, why are we doing this now when corporations are already sitting on $2.3 trillion in cash reserves? The largest amount of cash reserves corporations have had since the Clinton administration, which have not translated into a hike in wages. I think there are other trends that we should look at as well. I think debt is something that we should be very concerned about, something I'm surprised that you guys aren't more concerned about as well. The World Bank has done a study that shows that once you're over this critical threshold, 77%, it comes up in study after study, every additional percentage point in your debt to GDP ratio costs your economy 1.7% in growth. Ladies and gentlemen, we're already at a 104% debt to GDP ratio. At this point, losing revenue and taxes, raising the national debt to this extent will have devastating economic effects going forward for years to come. And what is debt, after all, but a tax on our children, but a tax on tomorrow's growth? Frankly, what is this tax plan but a transfer of wealth, a transfer from young to old, from poor to rich, from people in states that did not vote for Donald Trump to people in states that did? And I look forward to addressing each of those points as we go forward, but I want to give you the chance to respond to that first.
Yeah, so I think there's three main arguments that have been made here. First is the argument about these companies are already holding a lot of profits, and so why would we do a plan like that right now? So there's a lot of things moving in the international economy. One of the reasons why companies have so much held in profits is because of the massive policy uncertainty that existed over the past 8 years. And so actually my primary advisor, Nick Bloom, has a lot of work about policy uncertainty, and he introduced an index called Economic Policy Uncertainty, EP, yeah, there we go. So it's this index that measures over time how uncertainty looks like in the US economy. And it skyrocketed during the financial crisis. And so a lot of companies were just holding back because they were so scared to act. And so what we have now is kind of like an overhang from that period. So again, recapping there is that there's a lot of factors at play, and it's not, and so we're kind of recovering from the financial crisis. In addition to that, just because we're kind of in that process of recovery doesn't mean that we shouldn't do a good thing. So if we persuade you tonight that this is going to lead to expansion of jobs and expansion of wages, then we should do more of a good thing that we already have. Now I want to delve a little bit more into the arguments that you made about the deficit. The first part is just that there's a lot of estimates out there, and I mean we're even kind of confused about, like, one model might say, oh, 2 trillion, another might say 1 trillion, and another might say 400 billion. It's like, where do we put our confidence in some of these numbers? And so we would welcome any debate about the quality of different forecasts, but we've seen so much spotty coverage of models out there without any transparency about the assumptions in those models that we would really like to delve into that further. And just to give you an idea of some of the contrast, one of our faculty here at Stanford, Daryl Duffy, in the GSB suggests that this tax plan would really increase the growth rate of GDP, but another professor, who I coincidentally TA'd for, Raj Chetty, suggests that it wouldn't increase GDP growth. So even among really world-class economists, you get different opinions. So we just want to say that there's not this kind of like black and white answer of, oh, it's definitely going to reduce or definitely going to raise. We're going to try to persuade you that the evidence is in favor of the increasing growth. And the last point that I'd like to make right now is just that if we can increase growth, taking out a little bit more debt is not necessarily a bad thing, because what ultimately matters is debt to GDP ratio. So if we get GDP growing and that takes some debt, that's not a bad problem. I mean, today we're all undertaking investments in our human capital because we believe that in the future we'll be able to use that human capital. And so Ed Prescott, a Nobel laureate, wrote in 2004 in a paper in the Minneapolis Federal Reserve that, and I'm just going to quote word for word, he says, the large labor supply elasticity, which I'll explain in just a second, means that as populations age, promises of payments to the current and future old cannot be financed by increasing tax rates. These promises can only be honored by reducing the effective marginal tax rate on labor and moving toward retirement systems with property that benefits on the margin increases proportionally to contributions. So what that's saying is that the way that we run down deficits and we increase growth is by giving people more opportunity to work. And that the way that we're going to solve the deficit problem in the United States is not by taxing more, but just getting GDP growth up. So we'd love to engage more on this debate about maybe what the forecasts are suggesting and how to increase growth, but we would just really like to push this point about growth.
And then one more thing, to address your last argument, which I think, can you correct me if I'm wrong, are you addressing the state and local tax deduction having a cap now? Is that what you meant by taxing states that did not vote for Donald Trump?
Yes.
Okay. So to explain what that means exactly, previously, and still to a limited extent currently, taxpayers who live in states and localities that have local and state taxes, which is almost all of them, can use them as a deduction against their income for federal taxes. And that is what I think the Stanford Democrats were referring to when they said that. It's that because in the Republican tax plan, in order to reduce the net loss in revenue, there was a cap placed on that at $10,000 of state tax or local taxes that can be deducted against federal income as a deduction against federal income taxes. And the issue that I would submit to you here is that, for one thing, many lower income people, middle income people, even in so-called blue states that tend to have higher taxes and higher spending, will still have a majority, if not all, of their tax liability that they could deduct under that deduction covered under that deduction. So thus, it will not tend to harm the people at the very bottom of the income scale. Also, I think on a principled level, the United States is a federal republic. That means that the federal government and the states have certain responsibilities, duties, and freedoms from each other. In this case, there's no reason that lower tax states that have lower spending ought to have to indirectly subsidize higher tax states with higher spending just because those people in those higher tax states that benefit from that spending end up getting to deduct that spending through their taxes against their federal taxes, thus paying less in the way of taxes than they otherwise would, and then making it so that the people in these lower tax states who don't have as much opportunity to deduct because they don't have as many taxes in the first place end up having to indirectly pay into a system in which they're not getting as much benefit as those in the higher tax states. So I think as a matter of principle, as a matter of fairness, this never should have existed, the state and local tax deduction, and therefore this is just rectifying a historical wrong. It's not at all an attempt at punishing anybody, an attempt at being, I guess, unfair to anyone. In fact, it's an attempt to bring back fairness to a code that, in a federal system, a specific rule that never should have existed, because states are allowed to tax and spend as they wish, but also are responsible for raising that money themselves and not having it subsidized by other states' tax dollars in the federal government.
Okay, so before we take away, just to address that last point regarding the interplay between the states within our federal system, correct me if I'm wrong, but I do believe that the vast majority of the states who their tax base will be affected by the SALT cap, they are also the same states that actually give more to the federal government than they receive back. So those are the states that are actually providing benefits and indirect subsidies to federal programs that the other states are. So in essence, the economic argumentation is reversed. We're arguing, in essence, that the states that are going to be receiving the burden for the SALT cap deduction are the same states that have already proven through their mixtures of unique policies certain forms of economic growth that is actually powering the American economy, creating jobs, and contributing more to the federal government than we're receiving back. So when it comes to federalism, these are systems that have proven already to be working. In a federal system, states should have the ability to chart their own course and to enact policies that they believe are best suited to the needs of their populations. And if you have the federal government come in and clamp down on those policies, That is a contravention of the principles of federalism in that regard. So just to continue, Caleb?
Sure. I would like to now address some of the other points that were raised by our Republican friends. I had almost difficulty in believing my ears when they suggested that it is good for the government to borrow money to stimulate the economy. Keynesian Republicans, I never would have thought of it. I think it's important to be mindful that you can't do that. That's not something that mainstream economics believes, that by borrowing money and then spending, basically distributing it on stuff like tax cuts, you can generate enough economic growth to pay for the benefits of that you've just handed out to people. It doesn't work like that. As for the question of economic forecasts are not like suits. You can't try them on until you find a color you like. You go with that one. There's a right answer and there's a wrong answer. And there are a lot of estimates out there, and I will say that is fair. But there are some estimates that are better than others. And I would suggest that a reasonable one for us to use tonight would be the one that came from the Congressional Budget Office, which has a long-standing reputation for being fair, nonpartisan, which does take into account growth impacts from tax cuts, and suggested that after taking into that account, that this would add $1 trillion to the United States deficit. Now, that's after taking into account the economic benefits. So that is certainly something that you should be sure to be mindful of there. In general, I am a little bit troubled by some of the suggestions that by these tax cuts are going to have these massive economic benefits. I think you cited a survey earlier suggesting that $1 of tax cuts could lead to $3 or $4 of wage growth.
He actually said 1% of corporate tax cuts.
Yeah, 1%.
1%
Yeah.
corporate tax cuts.
Would lead to 3 or 4%.
Not $1.
No,
3 to 4. Yeah.
$3
So
to
like if you
$4.
change the a percentage point increase in corporate tax rates would be a $3 to $4 decline in average wage and vice versa. But
Okay,
yeah, no worries.
misheard that
Yeah,
part.
continue. Yeah.
My apologies there. But yes, in general, the gravity applies to economics as much as it does to physics. What goes up must come down, and the bill will come due for these tax cuts at some point, and we hear nothing on how they propose to pay for it.
Yeah, so I think there's two separate arguments being made here. Let me first take on the deficit argument. So completely agree that we should not borrow trillions of dollars and then get people to dig ditches with that money and hire people to do that. That's like a Paul Krugman sort of argument to do. What we're advocating is that the government should not take as much of our money so that we're able to make better decisions about how to allocate it. Same thing with companies, so that companies can spend more of their own money that they're generating based off of good business models. I mean, if you're a manufacturer and you make a really good product and you spend all that time trying to sell it to the right consumers and building the right gadgets and all that kind of stuff, you want to be able to keep that. So we're making a separate argument versus the stimulus-based argument that some Keynesians would make. Just want to make that really clear. In addition, so tax rate reductions, I think we provided some evidence before. I don't think they refuted about declines in corporate tax rates lead to increases in real wages. That's based off of evidence across countries. That's Hassett and the Thorpe paper that we cited earlier. There's also additional evidence by a group of economists, two economists in Journal of Financial Economics, Mukherjee et al. It's just a recent paper that came out this year that showed how declines in the corporate tax rate lead to increase in R&D. And so there's a lot of new product innovations that companies are able to actually create when they're able to make more prudent decisions with their own money. And so as innovation and as growth goes up, people are able to have more money in their pockets, and that gets filtered down to the average worker. They made some points about the deficit that I want to come back to. Just to give you a couple examples. So the CBO is great. I really want to be really clear that I'm not casting any aspersion against the CBO, but it's really important to put their estimates in perspective. So back in 2010, when the ACA was being passed, they said about 21 million people would enroll in the exchanges in 2016. The actual number was 10 million. So, I mean, it's quite a bit off. It's not as if you're saying, 21 million and it's 20 million. So so that was with the ACA. They've made predictions a lot in the past before. So for example, in a Forbes article, the CBO predicted that Medicaid enrollees would cost around $4,200 per enrollee in 2015. It turned out to be wildly different. It turned out to be around $6,366. So I could go on and on with lots of examples, but what I just want to paint a picture of is that the CBO estimates are there to be a framework. but they're not as if that's kind of the be-all, end-all sort of conclusion. The CBO models do not take into account dynamic effects. So if I give somebody $1, that means that they have more money in their bank account that they can go out and spend. And as a result of that increase in spending, then companies are going to change their behavior. So those dynamic effects are not included in the CBO model. And part of the reason is just because there's all this infrastructure that builds up in government agencies, and reforming these models is super difficult. So that's actually a big just bureaucratic nightmare of actually going back and kind of changing the assumptions in these models. I think lastly, one of the arguments that was raised, so just to recap on that end, if we win that GDP growth goes up as a result of the decline in the tax rate, that means that debt to GDP overall is going to go down. I printed out a plot. It's going to be hard to see from the back, especially because my printer has low ink. But maybe for the up-close audience. So in 2008, the deficit was at about 50% debt to GDP. And then at the end of Obama's presidency, it was about over 100% of GDP. So it literally doubled in a span of 8 years. And so we agree we want to take the deficit seriously. Unfortunately, the prior administration, we believe, did not take the deficit as seriously as one would hope. And then lastly, with regard to the state deduction and just to transfer across states, we want to point out that there's a lot of reasons why states contribute differential amounts. The composition of people in states are different. The welfare programs, the education system, there's hundreds of differences. And in fact, military expenditures, just the amount that a state contributes to the overall federal government military explains about 66% of the variation of the variation that we see in public welfare programs. So we think that the argument that, hey, the reduction was trying to sideline the Democrats is not quite right, because there's a lot of reasons why that explain this dispersion that we see, and 66 being explained by military expenditures alone seems like a large number. But we'd be happy to come back to this point if that's an area of contention, and Philip has some more remarks on
One
that.
time check, quick.
Yes.
Okay, maybe we went
The
over.
Dems have 9 minutes and 31 seconds, the Republicans have 5 minutes and 55.
Okay, one more quick clarification. To clarify what Christo said, the 66% meant that the variation between what states contribute in terms of tax money to the federal government and what they get out, 66% of that is determined by military expenditures, which comes from the fact that a lot of Republican-leaning states are small. So whenever they have even one military base per capita, that's a lot of money. So yes, you could say that's money flowing in, but it's a public good, and it's something that is not a welfare contribution or saying that taking from another state. It's because that's where, for national security, that's the optimal location of that base. Also, I would like to communicate another estimate that people use that does take into account dynamic estimates, is that the Tax Foundation, in its static estimate, said that the deficit would increase by $1.47 trillion. But whenever they took into account the increased economic growth, they said the deficit would only be a net change of $448 billion over 10 years. And if you take into account the economic growth that would have to account for over $1 trillion difference in tax revenues alone, it would likely end up reducing the debt to GDP ratio, or at least keeping it about even. So that's another thing to consider.
So at this point, there are just a couple points that I wanted to address. I want to turn over to Matt and Caleb. Firstly, I noticed when you were discussing the differentials among the states, you at first were pointing out how the government should be taking less of the money so that people who actually know how to allocate it can allocate it more efficiently, better. I would argue that a very similar dynamic will now be playing out in terms of the federal government and the states that are being affected most by the SALT deduction. Why is it that there is now a distinction between how the federal government is able to allocate money, which, as we pointed out, will be primarily towards tax cuts for people in the top 1%, as opposed to the states, who arguably do understand their populations better, they understand their economic situations better, they actually are able to provide more efficient allocation in that regard. So I would question not addressing this from both sides. Another thing I wanted to point out is when it comes to the innovation argument, I wanted to point out that as part of this bill, there is a tax on certain university endowments, including our own. Universities, I believe we can all agree, are centers of innovation. They churn out tons of cutting-edge research that people who are creating wealth, startups, people in corporations, industry, they're drawing on that research, they're drawing on those opportunities to really facilitate growth in the future. So I would question why it is that in order to get approximately $400 million over 10 years in revenue to pay for primarily tax cuts to the wealthy, Why is it that we're treating their decision-making ability as lesser than that of corporate heads? And another point I want to make clear is when we're discussing the differences again in terms of the states, we're not disparaging the services that the states who are relatively low income, who are not contributing to the federal government on a net basis, we're not disparaging them. What we want to point out is that even though the states that are contributing more, they do have a lot of these programs in place, you term welfare programs. The fact of the matter is they still have those programs and they still provide the majority of the economic growth in this country. They are proof of our laboratories of democracy that they actually can have a substantial safety net within their state and still be engines of growth. So I would again question why it is that the federal government is coming in and stomping down on their autonomy to set those policies in order to facilitate the growth of corporate ledgers. And Matt has points as well.
Thank you. Yeah, I think it's really important to point out, as both of you have now, that when the government makes decisions about taxation, it is making decisions about how to allocate our national wealth. It's making decisions about how our wealth should be collectively distributed. And I think that both of us agree that there are reasons why the government would want to do that, public interests, particularly because our economy has tended to disadvantage certain people. And you would hope that the decisions that the government makes about how to allocate our collective resources would go towards trying to help those people who are disadvantaged. However, in this case, our collective wealth is being used for nothing less than political retribution. The fact is, the elimination of the state and local tax deduction is weaponized taxation. It is weaponized taxation because the Republican Party has said it is weaponized taxation. I do recall prominent Republican congresspeople stepping up and saying that they're doing this because these states should have voted for Trump. I do recall people saying that the taxes on universities, which are going to crush innovation. In fact, I remember being in this room last quarter listening to my friends in the Republicans talking about how our endowments are so inviolable that we could not dare to divest from fossil fuels at risk of cutting them down. This tax on endowments, Republicans have literally said that this is meant to teach them a lesson about indoctrinating liberals. You can look this up if you'd like. Now, I want to look at how the Republicans have decided to allocate wealth beyond just from Democrat to Republican. Though it is pretty scary to think that our government might be weaponizing the tool of taxation in a way that scholars like the esteemed Francis Fukuyama, who teach us here at this university, would call neo-patrimonialism. When the leadership comes in and the first thing they decide to do in office is transfer resources from the people who didn't support them to the people who do. But I'd also like to take a look, because we haven't brought it up yet really at all, on how we are transferring resources from sick people to healthy people. Because I think one of the roles of government, when we talk about life, liberty, and the pursuit of happiness, is to make sure that people who are suffering illness, to make sure that people who have health problems are going to be supported by our government. I hope we could agree on that to some extent. And I guess I'll start with the discussion of innovation, because in addition to taxing universities, and universities are where some of our greatest medical advancements come from, we're also directly taxing drug companies' research and development budgets. Within the GOP tax plan, there is a clause that reduces the deduction for orphan drug research from 50% to 25%, cuts it in half. Orphan drug research, for those of you who don't know, is research looking into developing cures for terrible illnesses that affect only a few people. So if you suffer from a rare and obscure illness, a company might have to spend a lot of money in order to find a cure for it, and wouldn't think that that's particularly profitable. This deduction is critical to making sure people who suffer from rare diseases will find a cure, and this cuts that. And of course, we'd be remiss to let our time go by without discussing the disastrous effects of repealing the individual mandate of Obamacare. And beyond being a really dirty way to try and repeal Obamacare, what we see here is a CBO estimate, and we both have established that we trust the CBO, that 13 million people will drop their plans. Now, 13 million people dropping their plans, yes, that will save the government $338 billion in subsidies, but it won't save the American people a penny. In fact, those people are now going to have to shoulder an even greater burden as these costs are shunted onto them. And we expect healthcare costs to rise. That was actually one of the reasons why Susan Collins refused to sign on to the bill until she was promised that the Murray-Alexander bill would be signed. And guess what? It wasn't signed with everything that she was promised. And the result is that whatever savings there are going to be in the government from getting rid of these subsidies, the American people are going to pay even more. In fact, the $7 billion in subsidies created by Murray-Alexander will not affect healthcare costs created by mandate repeal. That also comes from the CBO. And while we're talking about the deficit problems,
2 minutes and 20 seconds.
what's that?
2 minutes and 20 seconds.
Okay, great. Just one more point. And while we're also on the topic of projections for how this is going to affect our deficit, how this is going to affect our GDP, the Tax Foundation had one of the more reasonable guesses for how this tax bill is going to affect our deficit. They said it would only add $448 billion in debt, but it said that simply repealing the individual mandate alone would cost $700 billion in opportunity cost, in lost growth. So thank you.
Okay. I would like to first start by addressing the state thing. You stated that we were weaponizing the tax structure. I think it's a little bit remiss to say that asking states to have to cover their own state expenses and asking them to have to fully pay for their own state programs is weaponizing anything. I think that's just a question of fairness. I mean, even if tax dollars are net flowing into states that have lower sets of programs, we already established that 66% of that difference is explained by military costs alone, and there are more other different reasons that for the other 34%. And moreover, I think it's a question of fairness. There's no reason that there should be state taxes that are to fund specifically state programs ought to be subsidized by other states. Even though I understand we want to have freedom for the states, I totally agree. I embrace federalism. The reason is that in a federalist system, the corollary to that is states have to pay for their own programs that they want to embark upon. And if they start to work and they continue to work, then the states want to continue doing them when they have to fully shoulder the cost. That is entirely reasonable, and that's their choice. More power to them. I think that that's just, we need to think about the true laboratories of democracy, as the Democrats mentioned. We want to actually have them be in a fully sort of autonomous way in running their state budgets and running their state programs, and they cannot do that whenever we're offering some states essentially a subsidy to spend more.
And then how many more? About 30 seconds.
20 seconds.
How many minutes?
3 minutes.
3 minutes. Okay, great. So there's two other issues that were brought up in that speech. Number one was about universities. And the universities being taxed. To my knowledge, there's about 30 private universities that are going to be taxed as a result of this. We're not going to get behind everything in the tax bond and say like everything is absolutely great. This is a small issue. They have not impacted why it would reduce innovation that much. Stanford has a ton of money. This is not like a huge burden to Stanford, to other private institutions that have billions of dollars in endowment. It was probably a legislator that wanted to get a little extra funds so that they could fund something in their state. I'm not sure who that legislator was. I agree, maybe it wasn't, we agree it's not like it's a side issue, I think. If we win that corporate tax rate reductions lead to greater investment from firms, and that leads to greater innovation and so on, then I think that kind of wins us the round, because that's showing how the average worker is going to be able to benefit as a result of the tax plan. They also brought up, again, the point about healthcare. Maybe there's another room where the healthcare debate was supposed to be held. I think this debate was about the tax plan. So as long as we win that reducing marginal tax rates, reducing corporate tax rates, and simplifying the tax code is good for the American people, I think that's a reason why we win the round. We could spend ages talking about healthcare. I think last year, actually, or was it last quarter? Maybe Lanhey and my advisor Mark Duggan debated that out. So that's another debate that we would love to have. But nonetheless, let me make two quick points on this. Number one is that the CBO estimates are way off. So we talked before about the CBO estimating 21 million enrollees, and it turned to be out 10 million less. And so when they're talking about all these rising health costs, we agree healthcare is a huge problem for the United States, but that's not the best way to resolve it by imposing Obamacare. There's many other solutions that have been put on the table, and that's for another debate. In addition to that, what the healthcare law was doing was raising premiums for a lot of people, and so the Trump administration wanted to kind of put a hold on that, so that then we could have a future discussion about healthcare. I think, just to kind of recap, as long as we show that, as we've kind of been showing before, that corporate tax rate reductions lead to increased innovation, leads to higher wages, and I haven't heard any contestation with the Hassett and Mathur paper or the Mukherjee et al. Paper, then I think that's a reason why this is going to be affecting the average worker and making them much better off.
Yeah, so the Dems now have 1 minute and 45 seconds left of time, and the Republicans have 51 seconds.
Excellent. So just a very quick point, and I'll turn it over to my colleague. I just wanted to point out something that you just mentioned. You were saying when it comes to universities, they have billions of dollars, they have plenty of assets, they can afford to take the cut. I believe that was your language. I would just question, and I understand that you said that this is not an optimal part of the package, but I just want the audience to think about this question. Why is it that it's okay for universities with billions of dollars of assets, that it's okay for them to be able to afford an increase in their tax burden, but that logic doesn't seem to extend to these trillion-dollar corporations who have a huge, larger magnitude of assets on them? That's just a question I hope that the audience takes some time to think about.
And if I may, if you wanted to leave healthcare out of this debate, then the Republicans should have left healthcare out of the tax plan.
Okay, Caleb?
Sorry. Thank you.
Right,
Yeah. All right. So yeah, I do think that although we want to focus on a lot of the impacts, how the bill is paid for is an important part of it, and people losing health insurance and the destabilization of health insurance markets is a negative consequence that should be factored for. We aren't just talking about the glories of corporate tax cuts here. It's also important to be mindful of the many specific ways in which the tax bill has negative impacts. Something we haven't talked about is the impact on housing. Now, how many people here are concerned about low-income housing in Bay Area and other communities around America? Maybe a show of hands. You know, I see a lot of hands out here. It's a big issue. It's important to note that because of changes in taxes in this bill, it is estimated that the government's biggest program to support the construction of new affordable housing, low-income housing tax credit, is going to lead to the construction of 200,000 fewer units over the next 10 years. Thank you.
Thank you.
Okay, a couple of points. The first point is that for the university tax, the universities are barely, if at all, taxed at the moment. So I think this is just sort of bringing it up to fairness of having a slight amount taken out of their profits rather than absolutely nothing, whereas corporations already have taxes. So yes, I understand that we don't want to privilege the corporations over them, but they're at the moment not paying anything at the moment. So I mean, I think that a small tax to the extent of what's put in the law is not unreasonable, even though I don't personally agree with it. I don't think it's nearly as big of a deal as we were presenting it as. Also, regarding housing, in a New York Times piece titled "How Local Housing Regulations Smother the U.S. Economy," a U Chicago professor and a Berkeley professor basically argued that, so that 50% of American growth in domestic American cities has declined because of housing regulations. So that's the main problem with housing. It's not this small program of 200,000 housing units. It's more than that.
Okay, now you will each have 2 minutes for closing statements.
All right. Thank you. And thank you again, everyone, for coming out here tonight. We've heard a lot about the tax plan. I think a few important things to highlight. This plan will not pay for itself. It will leave a debt burden that we will all have to deal with and will have to be paid for somehow. I assume that it's going to be paid, that the Republicans will eventually propose will be paid for out of cuts to Social Security, Medicare, or other social welfare programs. Another problem is that the individual tax cuts expire after 10 years, while the corporate cuts do not. It is irresponsible to engage in massive stimulus when the economy is doing this well, because it hurts our ability to stimulate the economy when there is an economic recession and more stimulus is required. There's a variety of negative benefits. By taxing these centers of innovation that are the universities, which have a public purpose, when we cut taxes for corporations, which do not. We have negative housing consequences, 200,000 units is still a lot of units. Negative healthcare consequences, negative consequences in a variety of state and local governments. And I will confess that there are indeed some positive aspects of this tax bill, but a few good ideas stuck in a misshapen lump of bad policy whose form, content, and function do not seem to bear any relation to economic efficiency, a guiding ideological strain of thought, or the dictates of common sense, is not good for the American people. This is a massive missed opportunity. We must look at the opportunity cost here. There are better ways forward on taxation, and the Democrats stand ready to engage with all interested parties and finding a better way forward for the American people. If you're interested in being part of that, I encourage you to reach out and join us because we can do a whole lot better than this plan we have here today. Thank you.
Thank you.
Ready?
Yep. All right, thanks everybody for taking the time to be here and not doing your P-sets. I know this is valuable time. We also want to be clear that this is obviously a very complex issue, and so we hope to just have brought up some of the issues that we want you to be mindful of tonight. So there's a lot of kind of arguments being thrown around, and maybe we can get to some of those in the Q&A. But what I want to kind of do is boil down the round kind of into three central issues. Number one is that we've kind of emphasized throughout the evening that the tax cuts are going to have a large effect on people's disposable income. I think that's an argument that has kind of gone conceded throughout the night, that people are going to have a larger paycheck. Higher disposable income means that they're going to be able to do things like get their health insurance. And so when we're trying to talk about healthcare and all these other sorts of issues that are on the table, if people have more money that they get to keep at the end of the day, that gives them more autonomy and more choice. In addition, that's going to mean that higher consumer demand is going to affect what firms are doing. They're going to expand and they're going to create more jobs. Number two, we made a bunch of arguments about how the decline in the corporate tax rate is going to increase investment from firms as well as innovation. Those were arguments that kind of went uncontested. As long as if the burden on companies goes down, they're going to have more money to be able to pay higher wages and compensate employees. Many companies have already been doing that, and the fact that they've done that already just signals how serious they are about actually paying higher wages. In addition, we've kind of shown that there's been a simplification of the tax code, so the average person that is not able to afford really fancy accountants that are able to do all these tax gimmicks are going to be benefiting a lot from it. They've made some points about the deficit, but I think what's gone unconceded during this round is that as long as we increase growth more than we increase the deficit, then the debt to GDP ratio goes down. In addition to that, we just feel it's a kind of disingenuous issue for them to be making, given that the prior administration doubled the debt to GDP from about 50% up to over 100% of the kind of debt to GDP ratio. And so we agree that the deficit's important. We agree that healthcare is an important issue. But I think what we're trying to communicate tonight is that this tax plan is going to make it better for the average worker. Thanks so much for your attention.
Wonderful. And thank you everyone for being here. This has been a really interesting debate discussion. And I think now we're going to move into Q&A mode. So does anyone in the audience have any questions?
Also, before we go into Q&A too, just something to be mindful of. I understand that not everyone here is an econ major and that there was a lot of stuff in this bill. So if you have question or clarifying points too, I think that's also fair game, not necessarily just politically touched questions. So we'll have 30 minutes for Q&A.
You in a red shirt?
Yeah, quick question. So, for the Republicans in particular, you guys keep bringing up simplification, but the fact is that, once you move beyond the doubling of the standard deduction and the fact that you guys shrunk a small number of tax brackets into a slightly smaller number of tax brackets, the fact is the tax code is still a mess of loopholes and deductions that leave the effective rate far lower than the actual rates. So even though you simplify the brackets on paper, I don't think that there's been any effort to actually simplify the tax code in practice, meaning that different companies are now paying different amounts. There's still a whole stream of companies that are paying nothing. Do the Republicans make any conscious effort to actually simplify the tax code in practice beyond the shrinking of the tax brackets into smaller ones and beyond the standard deduction? I mean, what did they actually do to cut any sort of loopholes?
I actually would think that your question is a valuable one to have asked because I think that there is a lot of more room for simplifying things. I think the standard deduction alone for a lot of low and middle income Americans will make a big difference on their books, but in terms of companies, I agree. There's a lot more work to do. I genuinely hope this is not the final word on the issue, and I think that I intend to be contacting my representative and senator to that effect saying that the work isn't done yet. But I do think that a small step is something to be celebrated even if it's not a ton. But thank you for the question, one that I'm glad was brought up.
Hi, thank you everyone for the debate. So I want to ask, how will the bill affect married versus unmarried couples? As a lower income person who wants to get married soon, will it benefit me or not?
Well,
Do you want to start?
yeah, I'll tell you what, it's going to be harder to have kids. This is going to penalize people for trying to become parents. In the past, there was a deduction. It's true. In the past, there was a deduction of $4,000 that you could take off of your taxes for each dependent you could claim. Dependents, they could not be children, but usually they're children. So that would help people who had a lot of kids, generally on lower income people, more religious people as well, who would have more kids would benefit from this. Now the Republicans, when they wrote this tax plan, tried to do some voodoo, where they raised a different tax deduction that you would get from having kids from $1,000 to $2,000, and then cut away entirely the $4,000 deduction that you would have for each dependent you could claim. So while the Republicans go out and say, hey, we raised the child tax deduction from $1,000 to $2,000, they actually cut away this personal exemption from $4,000 to $2,000. So while they say they raised your deduction by half, they actually cut it in half. And I think that that's pretty unfair, especially considering the impact that it will have on a lot of low-income people for Republicans to keep on going out there and try and criminalize family planning. It's unfair to say that if we're going to make you have more kids, you're going to have to pay more for them.
Can we restrict this to the tax plan?
Sure.
Okay, so I would argue that family planning is absolutely irrelevant to this issue. And also, what you were talking about the personal exemption, which is the $4,000 deduction you were talking about. Yes, that is cut in half. However, on the other hand, the child tax deduction does go up, and also removing the personal exemption was part of the way to simplify increasing the standard deduction, and that increases by far more than the personal exemption did as well. So yes, maybe that one part goes away, but overall, people are still net better off, and I think that that's what needs to be taken into account here. Simplifying the tax code and still leaving people with net more money in their pockets is hardly something to be scorned.
Just a clarification, could you give some numbers here? How?
Okay. The personal exemption was $4,000 a person. The child tax credit went from $1,000 to $2,000, and then the individual or couples, since you were saying married couples, yes, that went from $12,700 standard deduction to $24,000. So the increase in that actually ended up being far more than the impact actually on either of the other two more dependent-related tax credits. So honestly, it actually probably swamped them in terms of impact.
Yeah, quick follow-up on that. Yes, the standard deduction would have gone up, but we've already discussed some of the healthcare and housing cost impacts of the bill. I think you might be perhaps referencing to the marriage penalty that is experienced by married filers filing jointly as opposed to individual filers, which is an issue that some people have with the tax code. To the best of my knowledge, this bill did nothing to address that, actually, which is kind of surprising on many certain level. So that's something that was not changed or addressed by this bill and did not make things easier for married couples in that respect.
Do you want to respond?
Okay, yeah, I will respond to that in saying that, yeah, the marriage penalty did not get impacted, regrettably. And also, regarding the housing, I would like to reiterate that the main issue, according to the studies we've looked at, has to do more with regulation than taxation. So I don't think this tax bill could have done that in a very significant manner or in a very helpful manner. It would have been crumbs.
All right, thank you. Next question. You in the back?
The economy's booming because taxes are simpler and lower. What do we think about transitioning to a flat tax after these successes with the new tax act?
You want to start?
Okay, we can start. I think that a flat tax would be a very difficult thing to implement. I think that when you couldn't even fully get rid of the state and local tax deduction, I think that it would be very difficult even to implement that even if you wanted to, and I think that there would have to be significant buy-in from the population, and I'm not sure that the American population's there on that issue, and I'm not even totally sure how I feel about it just because it would be such a radical change.
I think one of our faculty here, Bob Hall and Alvin Rabushka, I think wrote a book like 20 years ago in favor of flat tax. But I mean, yeah, I think like a lot of economists kind of love it because it's very efficient. But at the same time, I think given how much difficulty there was associated with just getting this tax plan passed, it would probably be a real mountain to climb if we were to try to go for a flat tax. But I think on efficiency grounds, it's probably pretty good.
Sure. Well, a flat tax would be a massive change to the American tax system. It would reduce taxes considerably for the well-off Americans. It would either considerably cut government spending that supports middle and low-income Americans, or it would considerably increase their taxes. So this would be an extraordinarily regressive step to take on many levels. It's important to note that first off. And secondly, although our Republican friends may argue that it's justified on grounds of economic efficiency, I would be concerned it might have negative economic impacts due to questions of political economy, because the benefits of having a progressive tax system is that through government programs, it allows for transfers to the people who are less advantaged by our current economic system. through a subsidized college and other ladders of opportunity. If we see these kinds of ladders of opportunity programs being devastated through funding cuts to support a flat tax, then I'm concerned that people are going to become more in favor of extreme protectionism and other kinds of programs that might benefit lower income workers as compared to higher income workers, but would shrink the overall size of the economy.
And just to quickly build off that, it goes beyond just equity considerations in a philosophical sense. It also goes towards equity in terms of our ability to provide economic opportunities and access to our workforce. Now, when it comes down to it, we have to make sure that our taxes are structured in a way that those who can afford to pay their fair share in a way are able to support these certain initiatives that many states, not just blue states, but also red states, are also doing to encourage the location of corporate headquarters in certain areas, ensuring that corporations have enough money to provide workforce training programs, to ensure that the public schooling system, as well as charter school systems, have enough money and they're in a friendly environment to actually produce enough wealth to keep the economic engine burning. So it goes beyond just the equity considerations. There's also practical economic concerns we would have with the flat tax.
In the back, blue sweater. Yeah.
Hi. So both the beginning of the debate and the last question kind of focused on questions of equality. And one thing that I remember, and I could be wrong here, but I remember you saying at the beginning of the debate that even though there was going to be like a small monetary benefit for workers, there was going to be a larger one for corporates and higher ups and what have you. And so my question for the Democrats is, does that then mean that you can see that there is a benefit to everyone? And if so, why does having like a higher benefit for the upper as opposed to the lower outweigh the fact that there is like a universal benefit for everyone involved?
Sure. Thank you for following up on that. We apologize if we were unclear about that earlier. But we would not concede that there's a benefit for lower and middle income Americans because the deficit will have to be paid for somehow. And we see that the benefits are so small for many of the working and middle class Americans for the next 10 years that it seems likely that once the bill does come due and deficit has to be paid somehow, it seems likely that they will lose more in terms of government transfers and such than they gain from the tax cuts they experience now. And also, as we previously mentioned, after 10 years, the individual tax cuts expire, and some of the lowest income Americans are going to pay more in taxes than they did previously before this bill was enacted. So that's going to be a direct negative impact.
The problem that we're trying to articulate here is that the gains that are going to people who are wealthier, to people who are older, to people who are healthier, those come at the expense, the direct expense, of people who are poorer, people who are sicker, and people who are younger. This is a transfer of wealth from one group of people to another. The benefits in this economy come from a reallocation, from the poor to the rich, from the sick to the healthy, from the young to the old, and even from the living to the dead, because we haven't spoken about the estate tax yet. Which is something, if anyone has a question, we'd love to talk about as well.
And just another last point on this issue. When it comes down to this, sorry to throw in another econ term, but the issue of Ricardian equivalence does come into play. In essence, down the line, the people on the lower middle classes who are receiving a nominal marginal tax cut right now, the rational economic thing to do is actually pretty much to hold on to that money so that when the bill comes due, they're able to actually pay off that long-term liability. The issue with that is that once the permanent tax cuts, because they're permanent, they're not going to go away. There's going to be an actual larger burden for the people who now are who will be on the hook for it to pay. So even if they kept all the money that they would be getting, which I remember seeing a tweet from Speaker Ryan, it was something like $50 a year increase he put in terms of a Costco membership. I don't know if that's going to be universally the amount of money that people get, but it's going to be so marginal in contrast to the increased burden they will inevitably have to pay, because these are temporary tax cuts for the lower middle classes, but it's permanent nominally for the upper classes.
And that shows what the priority was too.
Would you like to respond to that?
Yeah, so I think we maybe deviated a little bit from the question, maybe to rein in a couple of points. Number one is that about 45.3% of the population doesn't really pay individual income taxes, so there's kind of a composition effect here that if you're going to do any tax reform, is by construction going to affect people kind of at the top 50% just because the bottom 45% is already not paying. So I think the lens we should use to evaluate whether or not the policy is a good or bad thing is what happens after those people, the corporations, get extra money. Are they able to create more jobs? And that really comes down to the second point of tax incidence. This notion of tax incidence means that if I as a company get to keep more of my money, does that mean that I'm able to then open up a plant in the United States, or would I go offshore? And because the United States had some of the highest corporate tax rate in all industrial countries, that means that many US companies that are maybe multinational, they would decide to open up somewhere else that has a lower corporate tax rate than to do it in the United States. So really what this means is that you're creating a lot more opportunity for the average worker. And lastly, about the permanent versus temporary tax cuts, I think that we would certainly love to see things made permanent. Unfortunately, that was probably not something that the Democrats agreed to in Congress, but we would love to, I think it would be great to have it permanent. Ricardian equivalence was a term that was brought up. That's in the context of, I believe, maybe you can clarify more, but I believe that's in the context of stimulus. If I were to give you $100,000 today, the thinking behind this is that, well, the government's going to have to find $100,000 to pay for that sometime in the future. But if you're reducing the tax rate and the tax burden that people are paying, that's just giving more money to the people. That's not changing really for the government. I mean, that just increases the amount that people are spending. So that tax equivalence argument, I'm not sure applies in this setting. But anyways, I just feel like maybe we deviated a little bit.
You
I'm
can
maybe
come in
guilty
for
of
just
that
a
too.
few seconds on that one.
A short response.
Yeah.
I also have like a quick follow-up to, because there was a thing about your response that talks a little.
Okay.
So since they're about to speak, do you want to ask your follow-up?
Yeah, well, so my follow-up was because we keep on going back and forth, like, or you kept on mentioning that it's not going to be extended and it's going to expire after 10 years, but it seems to me that we have no idea whether or not it's going to be extended 10 years from now, and in fact, the only way that it wouldn't be extended would be if the Democrats decided to get rid of it. So it feels like to me that if it wasn't extended, that would be not on the Republicans who passed it in the first place.
It's actually the opposite there. And I mean, to your point before, it didn't matter what the Democrats thought of anything in the tax bill. Unfortunately,
Can we
they
get
didn't.
to the economics of this, please?
Yeah, well, actually, here it's not economics; it's just congressional procedure.
And
The
also,
Democrats.
before we keep going, too, please get a quick time check as well.
Yeah.
Yeah, we have 10 minutes left.
It wouldn't be the Democrats who would have to stop the personal income tax cuts. Those just expire at the end of the given period. The Democrats would actually have to actively step up to get rid of the corporate tax cuts. But I wanted to address something that you said before quickly about the standard deduction. Since we are trusting the CBO account of things, the CBO says that the standard deduction would benefit 6 million taxpayers. That's about 47.5% of taxpayers, who are about half of the country. But as Mitt Romney found out in 2012, 47% of the country is not going to win you any election, nor is it anything close to a majority. So I think that we should strive towards a higher standard with that.
Actually, can I quickly?
I think, can we move on?
Okay,
Sorry.
sure.
We have a lot of, you in the green jacket?
Anyway, thanks to both sides. It was a really great discussion. I guess my question came with tax on endowments. I know you guys talked a lot about it. I know the Democrats said that it was going to really negatively impact innovation on campuses. We didn't really talk about the magnitude of the tax. So I was curious, how much is this versus the corporate tax rate, and at what level of endowment does it kick in? Because you said it was only going to be certain institutions. So just a little bit more discussion on the actual numbers of that. I think would be helpful.
Yeah, so it's only about, so this is again, just to put it into context, when we're bringing up the argument regarding university endowments just in general, I just wanted to point out in particular that I don't feel that the same principles are being applied evenly. The numbers, though, is I do believe it's about a 1.4% tax on endowments that are over, I can't remember the exact number, but it's like in the hundreds of
Yeah, you have to be like really
billions.
wealthy university to
Yeah.
it's something billion.
It's only like the top 30 or so universities. My concern, though, is just,
comes from.
yeah, my concern is just with the principle overall, with the fact that now we are it's essentially an assault on the nonprofit status of universities, as well as other institutions of a similar magnitude in terms of what they provide to the country. I would argue that it's a little bit troubling that now the precedent has been set for a tax on university endowments in general. I'm concerned that down the line, some other actors might expand on that. I don't want to get too much into that because I want to talk about the current plan as is. But just to put it into perspective, I was just concerned with the fact that they have such large assets, and it's felt that they should pay their fair share. My question would then be, why is it that businesses are given tons of loopholes that they can exploit in the tax code to avoid paying that fair share when they have orders of magnitude larger assets than universities?
And that's also just worth bearing quickly. If you guys are going to embrace this argument, SCR, that a 1.4% tax on university endowments is okay, then that kind of nullifies the argument when it comes to the fossil-free debate that it would negatively impact the endowment.
Okay, so my engagement is twofold. One, on the principle, I think Stanford Dems brought up a good idea that principle, you want to apply consistent principles. If you want to apply the principles to the corporate tax rate, you ought to apply that to universities as well. I think it's, again, a question of magnitude. Now, obviously, not all corporations are going to be ever paid to 35%. A few did, not most. But they still paid orders of magnitude more than 1.4%. And I think a rate that small is hardly something that's going to make a huge difference. And I understand the concern that perhaps in the future it might be used to justify much more, aggressive taxes upon university endowments. But I think, as it stands, I think it's reasonable to say that any organization that is engaging in economic activity of that order, and we need to make it clear, universities are, in effect, sometimes incubating startups. So yes, that's a good thing, something we should celebrate, but it's also something that ends up translating into private sector for-profit activity somewhere down the line. I think it's maybe a little disingenuous to pretend that it's all purely nonprofit. I mean, and I not as a criticism, but just in terms of defining what exactly they're doing and how that might be treated in a more fair economy. And then also, regarding fossil-free Stanford thing, I think that there's a difference between the government enacting policy that makes sense for it and Stanford imposing a limitation on itself, I think. I think that's a critical distinction.
Could you address the issue of taxation of nonprofits?
Taxation of nonprofits. In general, I don't think that a straight nonprofit, one that doesn't have direct those kinds of relationships helping incubate businesses, I think that's a different issue. Whereas I think with universities, often, since particularly Stanford is a good example of this, it's wonderful thing of often professors and sometimes students as well will found startups, and often sometimes it's built off research that happened at those universities. I think that is a net good for the economy, but it's worth considering that it's not as though the work going on at the university, even if it doesn't directly profit the university, is ending up contributing toward the emergence of not for-profit companies. So I think it's a little bit disingenuous to say that the research here is all pure research. It's often applied and intended for commercial use.
Are you all right if we move on to the next question, please? You in the back there.
Hi, I just wanted to say thanks to both groups for coming out. So I know we haven't had a question yet about the state and local deductions, or state and local deduction being capped at 10,000. So I know that the average state and local amount of taxes that an individual pays is actually roughly $4,000. And actually for I believe DC is the highest at 7. And so I'm wondering, would capping it at $10,000 actually negatively affect the upper earners in society more prominently than the average person? Because $10,000 is several standard deviations higher than the $4,000 average that most people pay in state and local taxes. And then second of all, to both groups, given that the top 10% of earners in society pay roughly 70% of all income taxes, isn't any sort of tax cut going to just necessarily benefit the top 50% or 30% of earners just because those are the only ones paying the taxes?
Sure. Yeah, I'll address that. So in regard first to the state and local tax deduction, I understand the concern for your point, and I think that just goes to show how poorly designed the cap is, because it varies a lot in the impact. So if you go to, say, Houston, into some of these lower places where housing prices are quite low, then yes, the cap is only going to affect the mansions and stuff like that. You come to a place like the Bay Area, you can have people in fairly affordable housing, and they'd still get hit by this cap. They still run up against it. because everything is so phenomenally expensive here. If you wanted to raise the same amount of revenue, it would have been, and if you wanted to focus it on higher income Americans, it would have been a far more efficient thing to do is just not cut the top marginal tax rate, which is what the bill did. And then now to get to your second point, which was about whether tax cuts necessarily have to be focused on the top Americans. Is that inevitable? I'd argue it isn't, because we already have a lot of really powerful tools to reduce taxes for working class Americans. The Earned Income Tax Credit, which basically gives people a refund, basically, if their incomes are under a certain level, and they are working out there, they are contributing to the American economy. That's a tax cut, in essence, which is through the tax program, and that does help working and middle class Americans without necessarily helping the people who are best off.
Okay. My response to the SALT issue, the state and local tax deduction issue, is that I think it's still, the principle here, I think, at least for us, I do agree that, yeah, it's not the most efficient way to go after the highest earners. I don't think that's the point of it, though. I think the point is that, in principle, it doesn't really make sense for there to be different, for any spending on a state level to be subsidized by the federal government just by virtue of being state or local spending. And I think that's the whole point of putting a cap on it. Eventually, really, the principle was to try to get rid of it entirely, but there were a few Republicans from higher property tax states who decided that they didn't want to go that far. So that was the reason that it was set at a cap. And yeah, I agree the cap is arbitrary. I think it's not necessarily the best idea. I think what should have happened is it should have gone away entirely, and any money saved there should have gone to further increasing the standard deduction. The other issue regarding people paying taxes, I agree that I will say that I'm a full supporter of the Earned Income Tax Credit, but I think that it's worth considering what that means. It's not so much actually usually a tax cut as for some of those people it's actually net giving them money from the government, so it's like almost a negative tax, and not that I oppose that, and not that I think the Republican Party in general opposes that. I'm disappointed they didn't find some way to make that more part of the bill, and I think it could have been better that way, and I think we can find some common ground on that. It's just that I think that if you're going to cut from what is being paid in versus actually make some negative distributions out, then yeah, I think it does necessarily have to end up having a disproportionate impact on the people on the higher end of the income spectrum because they're paying more in the first place. Now, if you're talking about distributions like this, then that's a different issue entirely, and I think that it's a distinction that needs to be made, even though I think this specific program is a good thing.
Alright, we're almost out of time, so I think we're going to take one or two more questions. In the red?
So most of your comments about the bill rested on the fact that you believe the corporate tax rate will end up increasing economic growth in the United States and therefore increasing the GDP. So, and you quoted various studies that do prove to some extent that a decrease in a corporate tax rate in a nation will increase economic growth in that nation. However, you didn't say any studies that connected specifically how this bill would affect GDP growth in the United States. And the University of Chicago's Booth School of Business hosts an IGM forum of economic experts, and they surveyed these economic experts and asked them specifically two questions about GDP growth. First of all, would the bill lead to increased GDP growth? And only 2% of these experts surveyed thought that it would lead to increased GDP growth. 36% were uncertain, and the rest disagreed to varying extents. In terms of the debt to GDP ratio, there were 2% uncertain, and everyone else thought it would make the debt to GDP ratio exponentially worse. So I was just wondering if you could respond to that, and if you had any studies that linked specifically this bill to increase economic growth.
Yeah, so I was looking at that same survey last night, and I was looking at some of the comments, and I was like, oh, well, yeah, I know this person would probably say this, and that person would say that. There's a lot of uncertainty. I think one of the reasons why people are a little bit uncertain is just because right now there's a lot of policy uncertainty about how we're kind of emerging out of the recovery. Is it a genuine recovery, or are we hitting another bubble? So there's a lot of things that are going on here. I think some people are actually legitimately a little worried about saying that they're going to get behind the plan. And maybe so if you asked them truthfully and they didn't have a survey, maybe more people would say that. With regard to the kind of, is there anything specifically about this tax plan? One of the limitations of our profession is that we're very much kind of historical. We'll get data from the past 20 years and then do an analysis on that, but there's not always that much real-time stuff. A lot of that goes to kind of policy organizations, and so I I mean, right now, I mean, there's not really anything that's being done super quick to